Okay guys, I'm going to go full screen and we're going to make a start. So thank you for joining us today, everybody. I know you're all very busy people. I guess the fact that you're here means that this topic is of interest to you. We're going to be going for about 30 or so minutes today. We'll have some time for Q&A at the end as well. So just bear that in mind and make sure that you turn off all notifications, get a pen and paper ready, prepare your questions as we go because there's going to be that Q&A at the end. So to keep it flowing, if you could just hold back until the end. Obviously, if you've got technical glitches, let us know in the chat and we'll look to fix those for you right away. But if you've got questions about any of the content in the webinar, there's going to be some time at the end to do that. And the content is only going to be about half an hour. So we'll be through it nice and quickly and you'll be back to your office. But in the meantime, I urge you to just switch off notifications and get focused on this content because there's going to be some really valuable stuff in here for you today. Years and years worth of technical experience digested into half an hour for you to take away and show off about in the pub tonight about how much you're going to know about share schemes. As I say, keep pen and paper with you because some of it will get reasonably technical and be sharing quite a lot of numbers with not too much information distracted us on the slide. So keep a pen and paper ready so that you can jot things down. We will also be recording the webinar, so you'll be able to rewind afterwards and pause on anything that you want to hear again. So all that being said, providing that you can all hear me okay and see the screen, we're going to get started. So in this webinar today about sharing a piece of the pie, which in a literal sense is about sharing ownership in your business, we're going to be talking about why planning for your eventual exit from the business is important. Might be something you're thinking about, might be something you've never thought about and you're just intrigued, but we want to just get clear on why it's important to be thinking about that in advance. I want to be talking about at what point you should be thinking about succession within your agency, because there is such thing as too soon and there's definitely such thing as too late. We are going to be talking about how you can use succession, share ownership, as a motivating factor for your key leadership team. And we're going to be talking about the opportunities and pitfalls associated with the various different schemes that are available to you. There are several. Today we're going to highlight the most common ones and help you to understand the opportunities and challenges that are faced within those various schemes. So for those of you who don't know me, my name's Paul Barnes. I'm from Blackpool originally, where I grew up with my mum and dad. What I realised kind of as I started to get into business is that years and years of my dad not enjoying what he did, and he was a plasterer by trade, going to work every day doing something that in his own words he detested, and coming home was quite common. And not only were people going to jobs that they didn't enjoy every day, which I couldn't get my head around, even people running businesses that they didn't enjoy. And I found it really disappointing, upsetting and confusing as to why people would continue to do something that they don't love every day. We spend half of our waking time working. Why should work be something that's a means to an end, and you need to get home to get away from the stresses and the anxiety of work? Make sure that you're doing something that you love. So I learned from my dad at a very early age that I need to make sure that I pursue a career that I love, and it gives me and my family what I want. And now I love helping other entrepreneurs to do the same. So a lot of what we're going to be talking today is the importance of making sure that you first and foremost are getting what you want from your business, and it's giving you the life that you wanted it to initially. That's my family there. That's my wife Penny, my two little boys Benjamin and Harry. So Benjamin's 3 years and Harry's 3 months. So they keep me very, very busy for different reasons. I'm the managing director of MAP. We're not going to be talking about MAP today, but just a little background for those of you who don't already work with MAP. We work exclusively with digital agencies who are serious about growing or improving their business, and we help them to make more predictable decisions that will give them significantly more profitable agency. Ultimately, that's what we're interested in helping agencies to do. We do that by implementing a full finance function and give the support and expertise that they crave so that they can focus on making improvements to their agency. So fundamentally, we're an accountancy firm that works exclusively with digital agencies, and that gives us greater insights into the industry, so we can benchmark success across the industry and give our clients the information they need to improve and grow. So that's a little bit about MAP. Today, I'm going to be talking about succession planning. We're going to be talking about share schemes. And the caution that I want to throw to everyone listening today is the same thing that we're told about on the airlines, which is all about applying your own oxygen mask first. And I've heard this analogy several times, but I did a little bit of research on Google for a bit of a laugh and to give me some context for today. On the airlines, they tell us that if we try and look after our children and our loved ones and other people before we've got ourselves in a fine, healthy manner, then it's going to be failure for everyone. We need to make sure that first and foremost, we look after ourselves and get ourselves into a position where we're comfortable before we can start helping other people. When I did this research, I got some really nice little quotes. So put yourself first doesn't mean you don't care about others. It means you're smart enough to know you can't help each other if you don't help yourself first. Really nice little quote, I think. We all want to be caring. We all care about other people, or we should do. But by thinking about yourself and caring about yourself doesn't mean that you don't care about others. You just know that you can't care about others if you don't look after yourself first, because you won't be in a position to do so. Second one, a little bit more random, but you can't pour from an empty cup. Take care of yourself first. Make sure you've got the energy and the mindset and the willpower to be able to help other people by helping yourself first. You're not required to set yourself on fire, so a little bit more of an aggressive one, to keep other people warm. So you get the point. You need to make sure that your own house is in order before you can start helping other people. And it's the same in sport, and it's the same in business. We don't just build anything significant all by ourselves. We do it with a team of people. And sports teams, one decade will look completely different the next decade because they'll have different people. And that's because we help people to reach their peak, both mentally and physically, and then they move on. And we have other people that are responsible for operating in that sports team or operating in that business. And we said on the agenda that we're going to talk about why planning for your eventual exit is important. Many people running small businesses are so passionate and so ambitious about what they're trying to build that they never think about life beyond their business. But at some point, the day will come when perhaps you're not as motivated anymore, you're not enjoying it anymore, or you're just getting older and you feel that someone else could better run and grow this business than you can, because you've maybe got your mind on other things now, or you just feel that the business will be in better hands with somebody else. And that's what this whole thing about succession planning is. It's relevant to everybody. You know, one day you will not own your business. That's a matter of fact, either because you transfer it to somebody else or because we pass away, in which case it gets passed to somebody else by default anyway. So this is relevant to anybody that owns a business. You have to be thinking about succession planning so that your business continues to thrive, and it becomes more something that's much more significant than just about yourself as the founder of the business. Timing is really important with this. As we talked about before, applying your own oxygen mask first. You must make sure that the business is performing well enough to give you the financial freedom and the time and enjoyment that you want before you can start diluting your ownership in that business and giving it to other people. So the business needs to be able to reach a level at which you're happy with, and that number, that stage is different for me than it is for each of you today. What we see as success is different for every single person. I'll give an example later of what I think success might look like for a certain individual, but it's different for all of us. And you need to make sure that you get to a stage where the business is performing well enough to give you the lifestyle that you want before you start trying to give that to others. And when you get to that point and you are able to bring other people into the ownership of the business, it's a hugely motivating factor for your key people to be able to think that they own a stake in the growth of this business, and that their actions and the results that they achieve, they are directly rewarded and motivated to do so. So you can use this as a real motivating driver for your existing people and people that you're looking to attract to the business as well. So fundamentally, we're going to be talking about share schemes today, and share schemes really come under two categories. If you've got pen and paper, so the first one is a share option scheme, and the second one is just a share plan scheme, if you like. So share option scheme will be agreeing to relinquish shares in your business to somebody else at some point in the future, and a share plan will be giving those shares to somebody now, either for a monetary value or otherwise. Share schemes are complicated. They take time to think through and get right. Many people get this wrong and end up regretting the decisions that they've made. And that's why I wanted to run this webinar today, because I'm independent. I'm not here to sell share schemes to you. I'm here as a business owner and a finance professional talking about what's available to you. But a share scheme may well not be right for you. And even if it is right for you, you want to be very careful in making sure that you set something up that you're going to be happy with for the years and decades ahead, and you're not going to live to regret. And that means getting the right provisions within your shareholders agreement. It means updating your articles of association. It means having a contract of all the scheme rules that you've put in place. And in summary, it means time and money with solicitors to get this right. This isn't something that you just go and set up on HMRC's website tomorrow. This is something that requires thought, and it requires having the right professionals around you. So I guess the most obvious way of diluting your shareholding in a business is to sell some shares to other people. So that's the most simple and clean-cut transaction you can have. It's just like selling to a third party. So you agree a value for those shares that you're willing to sell, but instead of selling them to a third party, you'd be selling them to someone who's you actually trust to help grow your company, because you've seen them operating within your company for a number of years. They've continued to step up. They've become fundamental to the leadership of your business, and you want them to be rewarded and motivated by having a stake in the company, and you want to sell them shares in the business. Well, this is very simple. You agree a value, they pay that value over to you. There's a tax charge on you personally. It's called capital gains tax. Normally you would qualify for entrepreneurs relief, meaning that you would pay 10% capital gain on the value of the shares that you transfer to somebody. And that's very simple, just like making an external sale. And that person has paid you the full value of those shares today, and they get those shares today. So that's just a simple, straightforward market value purchase. And bear with me, because I'm afraid that's as easy as it gets. The rest now will become a little bit more complicated. So I talked about share option schemes before. The most widely talked about is the EMI share option scheme. Most widely talked about just because it gives the most flexibility. The way that a share option scheme like EMI works is that it gives your employees, the people that you choose, you can select which people get in this scheme. It gives them the option to buy shares at today's price, but they don't acquire those shares until the future. So imagine you have £1 million company. Again, have your pens and paper ready if you like. £1 million company, and you want a certain individual to get a 1% share in that company. So let's say, obviously today's valuation for that 1% share is £10,000, 1% of £1 million, £10,000. But let's say you want them to have the option to get those shares in 5 years' time. You know, you want to keep them in the business for 5 years. You want them to help you to grow it over the next 5 years. Well, because they're now going to acquire those shares for a guaranteed price of £10,000 current value, any growth that they achieve for the business over those next 5 years is going to be, they're going to be entirely rewarded for that. So let's say that in 5 years' time, the business is worth £3 million. Their 1% share is now worth 30,000, but they're only going to pay 10,000 for it. So they're getting £30,000 worth of shares for just £10,000. And what you've achieved there is somebody who's been motivated to grow the business beyond what it was when you agreed the option, and an individual who's really pleased that they're able to acquire shares at a third of the price that they were when you agreed the price. So it's a win-win for you and the individual. And the reason you need a share scheme for something like this, such as an EMI scheme, is because that individual will not be taxed on the gain that they've made of the £20,000 in that example. So if you were to just do this in 3 years' time, you just decided to give £30,000 worth of shares for £10,000, you've just created a real issue for that individual, because they're now going to pay tax just like they've earned a £20,000 salary. So that £20,000 gain, they're going to pay income tax and potentially employees' national insurance for the benefit of having received shares worth £20,000 more than what they paid for. So the reason you need an EMI share option scheme is because you avoid that tax by running it through a scheme that's been approved by HMRC like this. There are limits on the size of the company, but I don't think anyone will be affected by that that's on here today. The limits basically mean that you have to have gross assets of less than £30 million on your balance sheet and less than 250 employees. I believe that I know everyone logged into this webinar today, and I don't think any of you fall in that bracket for the company that you run. £30 million of assets and 250 employees. There is also a limit on the value of shares. This is maybe more relevant. So any individual can only have options to buy up to £250,000 of shares. That's another limit to be aware of. You need to make sure you don't fall foul of the £250,000 per option. There's no minimum price on this. So providing that the individual pays today's market value, then that's the only stipulation, and they can exercise at any point that you decide in the future. So if you decide this is something that by the next year end or in 5 years, 10 years, 20 years, they can acquire these shares, the other way to do it is on exit. So at the point where the business exits, this person acquires shares. Then they will obviously make a gain on then selling those shares the same day to a third party. So very flexible in terms of exercise period and price. One of the real beauties for a company on this, which you might find quite incredible, is that you can actually get a corporation tax deduction at the time of exercise. So if we go back to our example, in 5 years' time, you've just given an employee £30,000 worth of shares. It hasn't cost the company of anything at all. The company has actually received £10,000 worth of cash for those £30,000 of shares. But because effectively the company has given away £20,000 worth of wealth, you can actually write that £20,000 off against your profits. So you've received £10,000, which you don't pay tax on as a company because it's just capital, it's not income. And you're actually able to write off £20,000 as though it's an expense for your company. Sorry if that sounds complicated, but I can't think of any easy way to explain it. But effectively, you're going to save tax as an employer, as well as the employee is going to save tax using something like an EMI scheme. Second share option scheme, very similar, is called a company share ownership. Company share, I don't know what it stands for, CSOP anyway. So this is a CSOP scheme. Under this scheme, you must actually hold the shares for 3 years. Unlike EMI, where you can do it, you can exercise any time. You must hold these options for 3 years, and then they can be exercised at an agreed price after those 3 years. There is a limit on this one of £30,000 of shares per person. So this is for much smaller transactions. You can only have up to £30,000 of shares per person. But everything else is very similar to EMI, including the corporation tax deduction that we talked about for the company before. Save as you earn, this is quite different. So this is quite an interesting one. Employees are able to make contributions from their net pay. So out of their net salary, they can make a contribution of up to £500 a month. So anything from £1 to £500 a month, they can put into a savings account that's held on trust by the company. And that gives them the option to buy shares that you've agreed at the outset. So going back to our example before, you're allowing an individual to buy what's currently £10,000 worth of shares, they could pay an amount of money out of their salary into a pot that means once it's reached £10,000 worth of savings, they can then acquire those shares, which will have obviously grown in value. You would expect if the company's growing. The difference on this one is that it has to be open to all of the company. So unlike EMI and CSOP, you can choose individuals. Save As You Earn, if you set it up, has to be available for all the employees. Otherwise, it works in a similar way. There is a really other neat little trick about this, though, which is that any bank interest that savings account has earned whilst the employees have been saving up, and any bonus that you decide to pay to those employees, you can pay into that bank account. They can take that interest and that bonus completely tax-free at the end of the exercise period if they decide they don't want to buy the shares. So you get to the end of the vesting period, they've saved up £10,000, which has been arised by contributions that they put in, interest they've earned, and bonuses that have been paid in there for them. If they don't decide to buy shares with that money, they can take that money out tax-free, which is quite incredible. Again, everything else is the same: corporation tax deduction for the employer and significant tax savings for the employee on both the growth in the shares and the bonus and the interest that they've accumulated within that bank account. There are tax avoidance rules that apply within Save As You Earn that you need to be careful of, because obviously HMRC don't want you just setting up these schemes with no intentions of actually giving your employees shares, just so that you can pay bonuses in, accumulate interest, and give them tax-free earnings. So you have to have a genuine belief that you've got employees that want to purchase, are likely to purchase shares at the end of the exercise period. SIP, a share incentive plan. So this one is about acquiring shares now for your employees, but then they keep them within a share plan for 5 years. If they do that for 5 years, then again, no income tax or national insurance, and they also pay no capital gains tax if they sell the shares. So you buy shares now, they sit within a plan for 5 years. That plan is going to earn dividends. Those dividends, the employees don't pay any income tax on. They may sell those shares when it's in the plan. You don't pay any capital gains tax. Whereas if you own these things outright, obviously you'd be subject to income tax and capital gains tax. By keeping them in the plan, you don't. You can then, as an employer, give free shares to those employees that have acquired shares through the plan. You can give up to £3,600 of shares in a tax year. So that's completely free of charge. You can gift shares to your employees worth up to £3,600 every year. Imagine if you did that for 10 years, that's £36,000 worth of shares that your employees acquired with no tax. Employees can buy more shares. So out of their gross salary, before they get taxed on their salary, they can buy the greater of £1.8 thousand of shares a year, or 10% of their salary. I said I was going to be careful not to make this too technical. Obviously, it's very difficult because there are lots of facts to share with you. But if anyone wants to discuss this afterwards, then I'm very happy to do so. For those partnership shares that the employees have bought, the employer can then now give you another 2 shares for every one. So they've already given you, as an example, £3,600 of shares per year as an employer. Then the employees bought some tax-free, and now the employer can give 2 for every 1 that the employees bought. So you could start to ratchet up quite a lot of shares for your employees at very little cost for them, and with no tax as well. And then the next one, growth shares, which has become more and more popular in recent years, although interestingly doesn't actually achieve it's not a tax incentive as such. This is a way of allowing other people to grow your company, but you isolate the growth that you've already achieved. So let me give you an example. Talked before about own oxygen mask first, that must come first. And let's say you want to make sure that, for you, that means that the business is making £120,000 worth of profit every year after you've been paid. So typically many small business owners now, we help them to get to a point where they're earning about £50,000 worth of income, because that's the limit at which, if you structure that in the right way, you can do it with very, very little tax. A couple of £1,000 of tax a year, you can earn about £50,000. You take 50 and you keep 48. If you get to that point and then you want about an extra £10,000 a month, building up within the business, £120,000 a year, and what you could do is to protect what you've built. So protect that 50,000 plus the 120,000 and say, I've grown this business to that point where it's given me combined wealth of £170,000 a year. And I've done that without the leadership team or anyone else having equity in this business. So you keep that part of the business as it is, but then you speak to your leadership team about them continuing to grow the business beyond the point that it is now. Typically, the reason that you would do this is because you've got to a point where you're getting everything you want from this business, but your leadership team are knocking down the door saying, we want a stake in this business. We don't want to be going elsewhere. We don't want to set up our own company. We don't want to work for anyone else. We want to work here, but we want to be rewarded for doing so. And we want to grow the company. And you say, okay, well, the first £170,000 worth of profit I want to keep, because I don't want to take a step back. I'm already getting that now, so I don't want to dilute what I'm already earning. However, if you feel like you can grow the company beyond what it is now, I'll take a little bit of a step back, continue to get my 170,000, and then we'll all share in some of the growth beyond that, but you won't share in the first £170,000. Effectively, this is done via setting up a different share class. So you have one share class now, it's normally called ordinary shares, and you would set up, say, like a Type A share class, and that Type A would be a different share class, which means that you can split the dividends how you like. So you could say, first £170,000 is mine, but there are 3 people in my leadership team. Any profits we earn over 170,000, we're going to split evenly. So me and the 3 of you are going to split the extra profits we earn above 170,000 between the 4 of us equally. So as well as you getting your 170,000, you get 25% of the growth, but they all get 25% of that as well without touching your earnings. Let me give you an example. So let's say you had retained earnings of £300,000. You earn the first £162,000 of that. That's the example I've got written down here. And the remainder is split 25% each. You would now end up with 162, which you were already getting before, plus 34,500. So you're now getting 196,500. But your leadership team are also now getting 34,500 themselves, as well as their salary. So you've grown your earnings from 162 to 196, and they've grown theirs from just salary to now earning £34,500 of earnings from dividends. You can make sure that the dividend payouts are voted by the shareholders, so that you can control how much dividends are being paid out. They can't now just decide they're going to pay themselves a dividend. You get to decide that. That's one of the beauties of having different rights for different shares. So your shares could carry more weight than theirs when it comes to voting. You can decide how to do that. Ultimately, all decisions can be left in your hands. So you could say, even though you've got 25% of the dividends over 170,000, I still have 75%, no matter how big this company gets, 75% of all voting rights. So I make all the key decisions, such as paying dividends, selling the company, etc. And then you could also decide that when you sell the company, you can split the proceeds however you like. So you might say that the first $1 million is for you, and then 25% thereafter is split between you, or anything else you want. You can have different rules for dividends, for voting rights, and for capital when you sell the business than the rights that you've got attached to the shares that you've got now. So you're not giving them a direct stake in what you've already built. You're giving them a stake in the growth of the company beyond what you've already built, without risking what you've been able to do yourself. So I said it'll be 30 minutes or so. I think we're just about bang on track. We went through why planning for your eventual exit from the business is important, at what point you should be thinking about succession within your agency, how to use succession as a motivating factor for your leadership team to be incentivized in the growth of the company, opportunities and pitfalls associated with each of the different schemes, and the importance of getting this right and not rushing into anything. And I think that's one of the main lessons that I regularly give to business owners, is that often they've had a bad day or a bad week, or they've read a book, or they've been to a seminar, and suddenly they've got this great idea, and tomorrow they're going to give away all the equity to all the key people so that they never lose them. They're going to set up a share scheme. And I'm afraid it doesn't work like that. If you want to do it right, you need to just take your time and think it through properly, and have multiple conversations over a period of time. Make sure you fully understand it and you're doing what's right for you and the employees and the business. And it all starts with what very few business owners have done, which is get to the point where they're already getting the life that they want. They've got control, they've got financial freedom, they're enjoying the business as it is first. You know, this doesn't solve fundamental business issues. If you've got fundamental business issues, they need to be sorted first. But once you've got a business that's performing and giving you what you want, then you can start to reward your team for helping you to grow something that's much bigger than you. Again, I appreciate that this is a very technical webinar and not one that's been easy for me to present to business owners that are not accountants like me. So my details are there. If there are questions, which I'm sure you'll have, please send them over to paul@myaccountancyplace.co.uk or speak to me on Twitter. My details are there on screen. Please prepare any questions if you want to put those in the chat now, and I'll review those. Have a think about any questions you want to ask me whilst you've got me for the next few minutes. We will be sending out the recording to everyone who's booked on today, so you'll be able to rewind and pause at will. Obviously, if you're a client of MAP and this is something that you're interested in, then you can speak to us next time we have a meeting, or arrange a meeting specifically about this. Again, we're not here to sell share schemes. We're here to help you to grow the best possible business. And if this has a part to play in that, then we can help you to do it. But if it's not right for you, or your business isn't at a point where you're getting what you want out of it first, then we won't be recommending that you rush into anything like this. So let me just jump onto the chat. You're welcome, Amanda. Really interesting. You are very welcome. And if you've got any questions, as I say, just let me know. See, that the type of scheme to go for is very much down to individual situations. Main question at this stage is who or how company shares are evaluated. Company shares. Do you mean, Frank, in terms of how you evaluate share values? Okay, Mr. Word, share values. Okay, yeah. Yes, so great question, actually. In order to put any share scheme in place, you must be able to understand what the valuation is of the company today, and you can get that agreed by HMRC. We can do business valuations. Sometimes you get business consultants or specialist people that just work on business valuations to work out, by using some common methods, what the valuation of the business might be today. Now, obviously, it's more difficult with a small company because there is less publicly available information about other small companies in order to benchmark yourself to see what it might be worth. But there are calculations that you can do that enable you to have quite a structured approach to valuing your business. I can share some of those with you over email if you like, Frank. Just drop me an email and I'll show you how those different valuation methods are done. But yes, really important. You want to value the business at the time that you're giving shares. Share options, apologies. You need to value the business at the time you're giving the options, and then you need to value them again when you're actually giving those shares to the individuals in the future, so that you understand the difference in valuation, and that gets agreed with HMRC. Great question, because if you're not actually selling the company, there's not an active market for it. It can be very subjective, but there are methods that HMRC will understand and are more likely to agree to if you follow those valuation methods. And often it comes down to compromise as well. So you might have chosen a certain method because it gives you a more favourable result, but HMRC can see that you've done that, and actually it doesn't represent the true value of the business. So they will often negotiate on that price. But if you've done it professionally, either with an advisor or worked out how to do it yourself, then you've got much more chance of it standing up for HMRC's perspective. And the most common way of doing that, by the way, is looking at other sales of similar type businesses and seeing what normally a multiple of profit they sold for. So if you're a business that's doing £200,000 worth of profit and the market suggests that most businesses in that industry go for 5 times profit, then there's a suggestion that your business is worth £1 million in that example. Another way to do it is to look at net present value of future profits. So if we predict profits over the next 5 years of X, but we've got to wait 5 years to get that profit, then you've got to discount that to work out what it would be worth today. So that's another way of doing business valuations. What is the average multiple in the digital agency industry? Great question, Lena. The average multiplier, from what we've seen, is quite wide ranging. It's somewhere between about 4 and 8 times profit. So EBITDA is the number that's used for profit, somewhere between 4 and 8 times. Now, obviously, that is a huge difference. 8 times is double 4 times. So it's the difference between £100,000 profit business selling for 400 grand versus £800,000. The reason the multiples are so wide is because the multiple will be decided based on various factors, such as how reliant you are on one client, how much retained income you've got, how reliant on key members of staff you are, how competitive the specific environment is that you work in. So yes, there might be millions of SEO companies, but if you're an SEO for travel in particular, how competitive is that environment? The more niche that you can be and the less you can be seen to have lots of competitors, then the more that will increase your multiple. So a lot of the same good business practice that you talk about for building a great business is the same thinking that goes into selling a business. Can it be removed from the owner? Is it not too reliant on customers, retained income, good cash flow, separates itself from the market by the way that it specializes? Then you're much more likely to get the 8 than the 4. But we know that typically it's somewhere between those. And that's an average. You can sell for more than 8 times the multiple if you focus on building your assets and building the value of your business rather than just building the profits. It's kind of short and short-term profit, but long-term you want to be maximizing that multiple as well and spending time on that. And even if you never sell the business or don't sell it for a long time, the stuff that you do to maximize the multiple is the same stuff that you do to just improve the quality of your business anyway. So you're not too reliant, you're not too much at risk of a big client leaving or a member of staff leaving or competitors just swallowing you up, eroding you on price. Okay, I don't think there's any more questions. If you think of anything after the webinar, you've got all my contact details. I'll leave those on screen there for a couple of minutes. And I'll just put myself on to mute and leave that on the screen so you've all got my details. And I hope to see you on the next webinar or at a MAP event soon. You're welcome, Dave. Yeah, drop me a line by all means. We can have a chat. You're welcome, Frank. Okay, great. Have a great day, everyone. Thank you for coming along today. Cheers.